Hello and assalamu alaikum everyone. In this lecture, we're going to talk about working capital. What is capital? Why is it so important to have working capital? Optimal level of working capital, and how much working capital do the business need based on its working capital cycle, and how can we manage its working capital cycle? All of that based on working capital. So, without further ado, let's begin. First, let's look at the definition for working capital. It is basically the capital needed to pay for your day-to-day running costs, day-to-day expenses such as purchasing raw materials, paying for electricity bills, and credit offered to customers is also counted as your working capital. So in accounting terms, it is calculated using the formula current assets less current liabilities. So if you remove current liabilities from your current assets, then you will have your working capital. Now, some of you might be confused about what can be classified in current assets and what are current liabilities. For those, here's this basic slide. So, working capital is essential to pay for day-to-day expenses and keep the business operating. It is calculated with the formula current assets less current liabilities. Current assets include cash in the bank, trade and other receivables due to settle their accounts soon, inventories, that is raw materials and components. So all these are counted as your current assets. Current liabilities, that is debts payable in the short term. So debts repayable to the bank, that is overdrafts perhaps, but overdrafts, do keep in mind that sometimes you don't have to repay overdrafts, or like they're an overdraft only represents the current liability if the bank calls for it to be repaid. Sometimes you don't have to repay the overdraft quickly in the short term perhaps, so in that particular case overdraft won't be counted in your current liabilities, but generally we are talking in general. So okay, debts able to repayable to the bank includes overdraft. Then trade and other payables who expect to be paid in the near future, and tax due to authorities. When we say these both trade receivables and payables, both are different things. Trade receivables are basically that your invoices that okay you will be receiving when you make credit sales to your business, to your customers. So you know that okay your customers will be giving you this particular amount for your customers will pay you after a month. So that is your trade receivables, that it will be accounted soon. Trade payables is that what you have to pay, so that okay in 1 month you will pay your cost, you will pay the price for suppliers to your suppliers, that is your trade payables. Okay, and inventories, of course, inventories is raw materials and components, that is also for part of current assets, and tax due to authorities is part of your current liabilities. So hopefully that clears the difference between your current assets, current liabilities and working capital. So we have talked about the basic definition about working capital, how it is calculated, and what concludes what is part of current assets and current liabilities, so we can get a better idea about what is working capital. So now that we have covered that, moving on, it is often referred to as the lifeblood of the organization, as it informs about the short-term financial health of a business. Without working capital, the business would be illiquid and unable to pay debts. Now, these terms about illiquid, you need to know that liquidity is about having sufficient short-term cash to be able to pay your short-term debts. But becoming illiquid means that you don't have enough cash in hand to be able to pay for your expenses. And do keep it in mind when we talk about liquidity that it's not the same thing as liability. Liquidity is about having cash in hand. Profitability doesn't mean that your cash needs to be in hand. Even if you have made a purchase, then it will take some time. If it's a credit purchase, perhaps credit sales, let's say you have sold an item, sold some products, okay, that is making a great profit, but you don't have that cash in hand right now. You will eventually have it in 1 month, but you have already accounted that. Since profit is accounted differently, you have already accounted that in your account that okay I will have so and so amount, and that's why I'm profitable. But you don't have that cash in your hand right now at that moment. You will have it 1 month later. So right now you don't have enough cash, you are illiquid, you don't have that liquidity, you don't have cash in hand. So there's a big difference between cash and profit. If you don't understand it now, there's a whole lecture coming up about the difference between cash and profit in one of the upcoming chapters about I believe it will be in cash flow forecasting. That is 5.5. That is where we are going to talk in more in detail about the difference between cash and profit. So look after that. Look forward to that. But for now, do keep in mind that the term illiquidity means over here that you don't have enough cash to pay for your debts in your hand. You don't have enough cash in your hands to pay for your debts if you don't have working capital. So it is lifeblood as in, like, humans have blood which keeps flowing. If the blood stops flowing, then you will eventually die. So same is the case for businesses, that if this lifeblood, that is this working capital, stops flowing in the organization, then eventually the organization will cease to exist, because it won't be able to pay its current debts, short-term debts. Now, the lack of working capital is very alarming, as we discussed earlier, but for a business, but too much working capital is also detrimental. Now we are like, why will we have like problems with having so much cash in hand? It is because of the opportunity cost. The opportunity cost we have talked about in the unit 1, chapter 1, that opportunity cost is the cost of the benefits of that particular thing which is lost, the other alternative option that is lost. So your capital is tied up in inventories, your payment receivables. You could have used this capital some in productive uses elsewhere, such as to purchase fixed assets or invest in banks. You could have invested this capital that you are holding up in your inventories in this particular method. So instead of having overstocking your inventories, you could have invested that in purchasing fixed assets or investing in your banks. Okay, so that's what we meant about the over opportunity cost, that why having high working capital is also bad. Now, effective management of working capital is required to make sure that cash flows are sufficient to deal with anticipated working capital problems. It is, of course, like we just said, that you should have enough cash in hand, but not too much to be able to deal with your short-term problems. It helps to take measures to remedy situations such as shortening credit period for customers if cash outflows are predicted to increase. Cash flows are discussed in detail in chapter 5.5, so we just discussed that, like, okay, if you have a cash flow forecast ready, that what will be, how, when and how much will cash go out of the business, that is your cash outflows, and how much cash will come into the business, that is your cash inflow. So if you have a proper cash flow forecast ready, then you can effectively manage your working capital as well. We're going to talk more about this management cash flow and working capital, like how do we manage your cash flow in order to manage your working capital in 5.5. We're in chapter 5.5, so look forward to that. But for now, we got a basic idea that, okay, having too less of working capital is also not good, having too much of working capital is not good, and how would we manage that? That's what we discuss in cash flow management, cash flow forecasting basically, but we don't discuss that right now since that's not part of the course. We just need to know the significance of working capital and about the working capital cycle. So over here, there's a little cycle that you can see, that cash flow, like, okay, first you purchase your items, then you produce them, then you sell and collect. You sell your items and collect payments from your business. That's when you get back your cash. So this is your business operating cycle, or you can say your working capital cycle. That is, okay, you have this cash in hand right now, you use this cash to purchase inventories, then it takes time to produce it, then it takes time for you to sell it, and finally you collect that payment, then you have your cash in hand. So this tells you how much time it takes for you to, like, purchasing machine, how much, when your cash goes away from your hand and when it comes back to your hand. It takes a lot of time. Your cash goes through a lot of stages to be able to come back to your hand with a increase. Of course, it isn't the same cash, of course, it has profits in it as well, but it takes time for you to, when cash goes out of your hand, it takes time for it to come back. So this is basically your working capital cycle, that this working capital's requirement for. So why is this working capital cycle important is that the working capital requirement for any business will depend upon the length of this working capital cycle. The longer the time period from buying materials to receiving payments from customers, the greater will be the working capital needs of the business. So of course, if you purchase items, let's say, of course, purchasing items, producing items, selling items and collecting them, the time taken for all of this won't be same for any business, right? So that's why the working capital needs of the business will also vary from business to business. And the longer it takes for you to purchasing inventories and collecting the payments from suppliers, we are saying collecting, not selling. Why? Because sell, we can also sell at credit sales. Most of the sales made are credit sales, so it takes time for them to be collected as well. So when we say cash, we are discussing about cash. So when we purchase materials, raw materials, and when we collect the payment from customers, the whole time taken is basically your working capital cycle. And the longer this time takes, then the longer your working capital needs. Working capital was what it was about. You're paying your short term, paying for your day-to-day expenses. So of course your day-to-day expenses are not reducing, but it takes time for you to have that cash in hand to pay for that particular day-to-day expenses. So the need of the working capital is basically my high. I get it that some of you might be confused about that, but it isn't much of detail. It's not very highly sophisticated or something. It's pretty simple that, okay, look that how much time it takes for the cash to come back in your hand. The greater this time takes, the greater will be the time, the more will be your working capital needs. Because you don't have that cash in hand, how will you be able to pay off your short-term day-to-day expenses? That means your need for the working capital is more. Now, working capital management focuses on 4 main components of working capital cycle. That is managing your debtors, creditors, inventory, and cash. When we say managing your debtors, that is, you can extend a shorter period of credit. So you can collect your payment at a shorter stage. So because of which your working capital cycle will reduce. You can manage your creditors, like extending a period of time to pay. So this payment you are making for suppliers could be made at a later date. So this time period is also reduced. Okay, so like this time period is extended, so it takes time for money to go out of your hand. It takes, like, the money is spending more time in your hand right now. Like, you're not giving it early and you're taking it early. Okay, I hope this is much more clear, that you are not giving it early, you are extending a period of time to pay, and you are taking it early by extending a shorter period of time credit. Now, managing inventory is about keeping sufficient inventory levels, preventing your unnecessary overstocking. You don't have to overstock. You don't have to give money. You don't have to use your current money to purchase unnecessary inventory levels, but you need to have sufficient inventory level. Okay, optimum inventory level, that okay, you just have enough for you to continue your production. We have already discussed about effective inventory management in chapter 4.3. So you can look at that, how do we manage inventory. And finally, managing cash. It's about cash flow forecasting. Like, okay, we have discussed that how much we can try to extend the period of time to pay. Like, we can give the payment out at a later date and take it at an earlier date. But even if we do that, there is still some time taking. There's still some time before we get our payment back. So what do we do in that particular case? Is by managing your cash, like taking loans or using some other sources of finance. That is basically your cash flow forecasting when we say managing cash. So I hope you get the whole idea behind this working capital management cycle. And efficient working capital management will overall reduce wastage of resources, hence improving your productivity. And with that, we are done with this chapter, with this particular lecture. Next lecture, we're going to talk about revenue expenditure and capital expenditure. So thanks for watching once again, and Allah Hafiz.